Hi, I'm Jeff Lovell, a staff accountant with AA Accounting, and today we're going to talk about how to avoid the shared responsibility payment under the Affordable Care Act. The Paycheck Protection and Affordable Care Act of 2010, or PPACA, is sometimes referred to as Obamacare. Under this law, medium and large employers must provide their workers with the option to buy health insurance, and all U.S. citizens and resident aliens, regardless of age, must have health insurance for themselves and their families, or pay a penalty called the shared responsibility payment on their federal tax returns. For 2016, the minimum penalty is $695 and is based on the size of your household and your total household income. Taxpayers with larger families and higher incomes pay higher penalty amounts. The penalty is capped at 2.5% of your total household income over your filing threshold, which is typically between $10,000 and $20,000, or $2,085, whichever one is greater. Total household income includes the income of everyone in your household who's required to file a tax return, even dependents. One way to avoid the penalty is to have minimum essential coverage, in other words, health insurance, for every member of your household for all 12 months of every year. Minimum essential coverage includes Medicare, VA insurance, COBRA, most forms of state-issued Medicaid, private insurance, insurance purchased on the Healthcare Marketplace Exchange, and employer-provided health insurance. Supplemental insurance like Aflac doesn't count, nor do standalone dental or vision policies, accident or disability plans, or workers' compensation. The other main way to avoid the penalty involves getting an exemption. The two types of exemptions are those that you apply for through the Department of Health and Human Services at healthcare.gov and those you apply for through the IRS on your tax return. Common marketplace exemptions include being a member of certain religious sects that are opposed to insurance, such as the Amish, being a member of a federally recognized Indian tribe, belonging to a health-sharing ministry, not being in the U.S. legally, or not living in the U.S. for over a year, facing an economic or other hardship. Common hardships include the loss of employer-provided health insurance coverage, having large outstanding medical debts, being bankrupt or insolvent, facing an eviction or being evicted from your home, being homeless, or the victim of domestic violence or a natural disaster or having your home destroyed, suffering from an unexpected illness or caring for a sick family member, or being incarcerated. Common exemptions you apply for on your tax return include the affordability exemption, which says that if your healthcare premiums are more than 8.13% of your income, the premiums are considered unaffordable and you're not required to have health insurance. The short coverage gap, which says you can have a gap in your health insurance for 2 months or less and not pay a penalty, or if your income is below your filing threshold. In other words, you're not required to file a tax return, or you only are required to file it to pay certain special taxes. Then you don't have to have coverage. The last option is simply to refuse to pay the penalty. The IRS has the authority under the PPACA to deduct your penalty from your refund. However, it cannot file a lien against your property or levy your wages or other assets or sue you to collect the payment. This effectively means that if you never receive a federal or state tax refund, the IRS has no means to collect the debt. You should be aware the IRS will still try to collect the penalty by sending you letters demanding payment, and the debt will carry forward to future tax years. If you have questions regarding the topics covered in this video, or other tax or accounting questions, give us a call at AA Accounting. Call us today to set up an appointment to discuss your tax situation with one of our tax experts. We can help.